Hello, everyone, and welcome to another Auto Trading live strategy session with Jeff Tompkins. This is Richard Van Rich hosting. We got Craig Ward in the chat, and we're really excited to have you guys with us on tonight. Got a lot of great information to go over. If this is your first time on, you'll notice that your microphone is muted. That's so we can all hear Jeff and I talk. But there is a Q&A box that you'll find at the bottom of your screen. And throughout the evening, we'll stop and pause for questions and also answer questions at the end. So definitely put those in there. If you have to hop off for any reason, don't worry, this is recorded and will be available on YouTube sometime tomorrow. So if you're on YouTube, please like and subscribe so you can get to all our videos. And it'll also be available tonight in our members area. So if you have any questions about your own personal account with us, subscriptions, access to Trade Trend, Zillion, anything like that, please email support@autotrading.com and we'll get to those tomorrow privately. So before I bring on Jeff, let me read through the disclaimer. Trading securities and options involves risk. Prior to buying and selling an option, investor must receive a copy of the characteristics and risks of standardized options. Investors need a broker to trade securities, and options must meet suitability requirements. Past results are not necessarily indicative of future performance, and performance figures are based on actual trades, including real money results. Due to time critical nature of trading, broker fees, and activity of other subscribers, there's no guarantee that subscribers will mirror our performance, and performance numbers shown are based on trades users could enter based on the trade signals. All right, with that being said, we're in the man of the hour, Jeff Tompkins.
Hey. Yeah, drum roll.
I need like a song.
Well, we were going to play Rammstein, Du Hast, when Daniel was on a couple weeks ago.
Yeah, we were thinking of that. We're also thinking of like that. He mentioned that David Hasselhoff song, popular in Germany. I don't remember what that was.
Yeah.
I think next time he comes, I'm going to have it ready for
him. Yeah, I don't know about that one. I think we should make
can't lose people.
Yeah. Du Hast is our theme song.
There you go. That's how we do it. How's your backyard going? You been doing any fishing from your
Oh man, no. Thankfully, they like got like a tractor and brought in a load of dirt and gravel and stuff and like filled it in. So the flooding's gone. Thankfully.
Oh, that's gnarly,
man. Yeah. So all is good.
Hopefully you're
here. Not as hot as Atlanta though.
I know, man. It's like 97 degrees. Craig's air conditioning went out. Mine went out in the same week. So yeah, it's like everybody all over town. Just like if you're in the air conditioning business, you're in the right business in Atlanta.
Yeah, right.
We're forging through though.
Yeah, well, good. Hopefully it cools off. Yeah, we're finally we've had an unseasonably cool spring. I guess today's the first day of summer, right?
Yeah. This usually like in the 90s by now for you guys, right?
Yeah, which it's on its way up there, but we've had like very, very mild spring, which is kind of nice.
Yeah, I just been drinking a lot of Budweiser on the couch. It keeps the temps down.
Yeah, there you go. I do that all year round.
Yeah.
All right. Well, welcome everybody. Interesting time in the markets with obviously now being in bear market territory on the S&P. Finally caught up with the NASDAQ. So we'll map out levels. But there's another interesting thing that's occurred and is really the reason for the topic tonight, which is major moving averages. So moving averages are an interesting tool and way to analyze markets and things. They have disadvantages and in terms of being lagging and whatnot, but there are some very major ones that are monitored very closely by institutions, and for that reason they fundamentally have value, but also to some degree are self-fulfilling prophecy. They just because they're so closely watched, it's a technical indicator based on average price from the past, so it's not necessarily doesn't necessarily have anything to do with fundamentals or anything of that nature, or may not necessarily dictate why a market should go up or down. But again, self-fulfilling prophecy, they're closely watched and traded from. So they do have a place, I believe, in trading and investing decisions, but not all of them. And there's of course a lot of subjectivity to them. there's many different moving averages. They're basically can be customized to whatever time frame and look back period that you like. So they're very subjective. And there's just so many of them. One person could look at one, a 9-period moving average and make a decision off that, while another person's looking at a 50-period. And so there's not a universal or fractal nature to them, in the sense that we can really, just say moving averages are, the holy grail, or they're great and we should all, use them as the sole basis for trading and investing decisions. Not the case, but there are some that I think are really valuable, and certainly historically speaking. So we're going to look at that on our session tonight, and are also closely watched by institutional traders, and they're those are the ones that really drive markets and the price of assets over longer periods. Retail traders may be able to move an asset price short term, but over the longer term, that's more determined by big money. And so we're going to look at the quote unquote big money moving averages tonight. And there's one that, again, the reason I chose that as a topic for our session this week is that there's one that we've just encountered, and price has, or is kind of currently seems to be moving from that average. So we'll talk about that and what to expect, short term, medium term, long term, and how to kind of interpret these and use them in our toolbox of our trading toolbox. So we'll do that, and then of course open it up to our ticker roundtable, so you guys can share symbols and we can look at what's relevant to all of you on the session tonight. Got a good group with us tonight, so glad to see everybody on. Okay, so let's go ahead and get over to charting. Flip off my camera here. Okay. So if you guys were on with us last week, we talked about standard deviation moves from the mean, and we've had kind of another what I call a slingshot type of setup. So we've been trailing this 2 standard deviation move from the 20-period moving average, or mean, and there's kind of a larger slingshot that started way back here in mid-April, and price trailed, and this is, by the way, of course, the S&P index we're looking at, trailed the lower 2 standard deviation band. We got a bit of a rebound. We haven't come back up to that volatility expansion, which occurred kind of right around the 4350 level on the S&P. But price did come back up finally and hit the mean, that's 20-period moving average, late May. Actually, traded above it for a while, encountered horizontal resistance around the roughly 4200 zone, and then sold off again. But we had another slingshot here over the past week, and prices trailed that lower volatility band. These are the Bollinger Bands, by the way. So again, if you weren't on with us last week, you can review the recording from last week's session on our YouTube channel. But we were starting to rebound off this lower band, and that's where moving averages are going to become the topic of our session tonight, because not only is it a move off a lower volatility band and a 2 standard deviation move from the mean, but also coincides with a very closely watched, and when I say closely watched, I mean, big institutions and big money are watching these averages, and that coincides with this move from a 2 standard deviation divergence from a 20-period mean, and then what we're expecting is some degree of a mean reversion. But big overhead resistance on the S&P around 3850. So I'm going to mark these out for you so you can keep an eye on them over the next week prior to our session next Tuesday. So let me draw this. So as we're rebounding, we had a big rebound today, right, across the major indices. We want to keep an eye on this 3850 level and 3800. So this 3800 to 3850 zone is going to be our major resistance that we're looking at as the market enters this rebound off of, in my opinion, a more significant moving average that we'll look at shortly. So this 3800 3850 zone on the S&P, major resistance zone, and also coincides with the volatility expansion from, let's see, what day was that? We had a big gap down, but basically from June 10th to June 13th. So the Friday to Monday, we get this big gap, volatility expansion, price trails the 2 standard deviation band, and then we rebound. So this is good news short term, but let's see, we closed today on the S&P at 3764. So we're not very far below this resistance zone. So if the rebound continues through tomorrow or the rest of this week, we're going to encounter probably some resistance in this 3800 to 3850 zone, whether it be a complete rejection of it, some stalling price action where we range within 3800 and 3850, or I think the less likely outcome is we just blow through it. And if that happens, then we turn from short-term bullish to medium-term bullish, because then we're really looking at a 4150 resistance, and so there's that level. So this is only if we break through this resistance zone, right? That's where all that price consolidation we talked about last couple of weeks occurred. So I mean, I could tell you from looking at the options chain what the probabilities we even touch this level statistically, but I can tell you, I'm sure it's very, very low between now and next week when we meet on Tuesday next week. So I won't go too far beyond that for now, but that's the next one. If we get through that, then we're looking at a medium to longer term, bullish scenario, and we're out of bear market territory. So I think these are very unlikely levels up here that will hit or break through. But we're most likely this week, between now and next Tuesday when we meet, we're gonna be looking at this 3800 to 3850 zone. That's where we're going to encounter some degree of resistance. So let's watch that. So where did this reversal take place? And it's not, we're only one day into it, so it's not a real, I'm not real confident about it yet. But if we look at the low from, let's see, the markets are closed yesterday, so this would be a Friday. It was off of 3687, which is also, we can look on a technical basis at that level and how price reacted to it last time the S&P was at that level. But it's kind of a arbitrary, random number. It's not a century mark, but close to 3600. Not a half century, a quarter century mark, but as I'll show you here shortly, there's something else. So there's something that probably most people are not going to look at or consider, but is very relevant. So not completely arbitrary, but really that level is, and again, probably should more accurately call it a zone, is 3,700. Okay, and I'll show you why 3,700 is so important in just a second. So we have a case for a short-term rebound for right now, and potentially a case for a medium-term rebound if we can, depending on what happens in this 3,800 to 3,850 zone. And then if, as I mentioned, if that breaks and we get closes above 3,850, then I'm looking at again more of a medium to longer term rebound. Really looking out, and it's premature to say this. I mean, hard to believe we're almost halfway through the year. So we got another, little over 6 months left in the trading year, but I feel comfortable saying we're going to have a losing year on the S&P. We're not going to get back up to previous all-time highs by December. It would really take a miracle for that to happen. So it's going to be a losing year. So, it's really important that we look at these levels, analyze them, and talk about how to use them to our advantage. So those are the ones we're watching for this week on the S&P. And again, we'll come back to the S&P here shortly after we look at the NASDAQ and the VIX and talk about why that this reversal that started today is significant. All right, so looking at the Qs, the NASDAQ 100 ETF. So across all the major indices, we got this rebound, but have already encountered the resistance on the Qs. Not the case with the S&P quite yet, but on the NASDAQ 100, we came up into major resistance today, and you can see it closed off, fairly off the high. The high on the Qs was 283.45, which was in the resistance zone from June 13th. Also June 15th. This one's may not seem as obvious, but see how price came up and then closed, although it closed high on the day, below that resistance. And then you can see back here in mid to late May, we had more bullish support off that level. So price was holding that level through May and then bounced off of it, but then came down and closed below. So that's kind of the I guess the contrarian view of this short-term bullish sentiment is that it kind of seems promising. We had such a strong move up in the major indices today, but caveat being that it was up into very, very significant resistance. And when a support level breaks, like it did here, and especially when it's a significant support level, where we had multiple touches and then a strong move off that level, when that's followed by a move in the opposite direction and a close, in the case of support below, and then a retest, and you can see that retest failed there. It failed at least today at that level as well. Then that's, while it's more bearish, it just means that level is very strong. So rather than try to say it's bullish or bearish, it's a strong level, which is a good thing because it helps us navigate future price movement. And how does it do that? Well, we know the level is strong. So if price is able to break through it and then close through it, and that's the key emphasis on close. We need to see price actually close above this level. Then we have a higher potential to move up. If this level continues to hold and serve as resistance and it can't get through, then it tells us that we're likely to see a move back down. And that's where we use the standard deviation bands. And again, was the main topic of last week, but you can see that they're a great tool. While they're dynamic and moving, they're not a static level like we map out with our horizontal levels. They're therefore, just like a horizontal level need to be monitored, and difference being with static horizontal levels, those don't move. We keep those where they are and continue to monitor them at that level. And those can hold for months and even years into the future. Whereas the dynamic levels, like a volatility band or Bollinger Band that uses standard deviations, we need to reassess those on a regular basis. And that regular basis should be aligned with your time frame. So on a daily chart, we really need to reassess those every day. And how we use those, the lower volatility band, which we have said is a 2 standard deviation move from the mean, which is the center band, is support. And the upper band, which is a 2 standard deviation move to the upside from the mean, is resistance, right? So we want to look for dynamic support, which is the lower volatility band, to align with static support or resistance. And so you see here where there was a volatility breakout, and again, the focus of our time last Tuesday, and a divergence of the standard deviation bands. And since price was falling the lower band, that's bearish. Eventually, any asset can only move so far in terms of standard deviation from the mean until it moves back, and that's called mean reversion. So it's a rule of statistics that it has to move back, revert back to the mean. And if those were static, imagine how easy it'd be to trade, right? But they're not, they're dynamic. But this is why we're looking at these things, because they're still very valuable, and we can use them even though they're constantly moving. And so see how price came up to this resistance level on the NASDAQ 100 ETF, and that level coincides with the volatility expansion. And again, what that is a divergence of the standard deviation bands. So the upper one's moving up, the lower one's moving down, and price is following the lower standard deviation band. So eventually, price is going to come back up and retest the level where that volatility expansion occurred. And so that's right here where we've mapped this resistance level. So that's already been completed. Now, why that's significant is that if price can get back up above this resistance level where the volatility expansion began and close above it, we tend to see stronger uptrends or even parabolic moves to at least to the middle band, and often back up to the upper band. So that's why we want to watch this level very closely. And again, that's right there. So see how price was above the lower standard deviation. So it was trading within 2 standard deviations of the mean on June 10th on this candle, gap down on the 13th, and then trailed it and then moved back up. So we're in a mean reversion period right now, mean reversion, but we're not back to the mean. Okay, so then let's look at the VIX and see what it's telling us. So the VIX has been really interesting. It's actually been a really helpful tool this year. Not that far. So we just look at 2022. And for those of you who are familiar with the VIX or haven't been with us on our past weekly sessions where we focus a lot on the VIX, let me actually redraw that. I like to use 35. There's been a very reliable, well, first of all, VIX is inversely correlated with the S&P, and because of the widespread correlation of the major indices, there's a spillover effect, right? So we see, even though the VIX is based on S&P 500 index options, it's still applicable to the NASDAQ and the Russell and other major indices. But it's inversely correlated. So when we see the market go down, we tend to see the VIX go up and vice versa. So we've talked a lot this year about this resistance zone between 35 and roughly 38. We'll just make it simple and call it 38 to 40 is our real resistance zone. We haven't actually gotten up there yet this year, but look what's happening. We keep getting up, especially into the 35 level. And every time the VIX gets up, so far this year, gets up into this resistance zone, it retreats and we see a rebound in the market. So we saw a rebound, a more significant rebound today, but this is to demonstrate what a great forward-looking indicator the VIX is, because it was all the way into last week that the VIX came up and rejected the lower part of this resistance zone. So that was our clue, along with other things that we're going to look at with moving averages, that and for confirmation, the follow through, right? So we saw the VIX starting to make bearish closes below that zone. And that's important. We want to look for that. So there's a 3 bearish closes and consecutive bearish closes, right? I had them here too. But all of these are closes below the lower range of this resistance zone on the VIX. Okay, so that's our forward-looking clue or indicator that we could see at least a near-term rebound in the S&P and the major indices. Okay, so that's happening. So we had advanced notice here, right? But then once that happens, we need to look for support in the VIX, right? And so let me zoom out just a bit here. All right, so this is also, again, when we use in combination with support and resistance levels, both static and dynamic, with volatility bands, the Bollinger Bands, and horizontal technical levels, what we want to be watching on the VIX. So see how there was resistance here? And this is going back into last year even, or now these levels I'm highlighting here are from 2021. But we've still seen it here in 2022, right? See the VIX reacting around this 2950 level. And look what it did today. There it is again, today. So when we ask ourselves, is the S&P or the major indices going to continue to rebound? Well, we need to answer our own question by saying, is the S&P and the NASDAQ trading into a resistance level? And we saw that as we just mapped those out. And is the VIX trading into a support level? Because it's inversely correlated. The answer is yes, it is. So right now, we need to wait for confirmation. We need to see the VIX close below this support level. So what I just drew here was support. I want to see a close below roughly 2950. Right there.
That's crazy. There's all that movement right around 2950 there like that. It's just straight across the board.
Yeah. And truly, like I emphasize, use these more as zones. Don't try to like pick a perfect price level, because that's not how it works. You want to look for like, and the more you do this, it's such a great exercise. You'll just get like I'm doing on our session. Just you can do it like it's driving to the grocery store. You don't even think about it. You just get in the car, drive, and you're not having to like think through it as it becomes second nature. So I can just spot these very quickly, but it's not an exact price. I'm just seeing that price is either moving up into a level and rejecting it, or it's moving down into a level and rejecting it. That's what you want to look for. And the more it does that, the more significant the level is. So it should be looked at, I guess, more as a zone than an exact level. So this 29 to 30 zone is what we want to watch. And then if you want to get really granular and like look at, the actual highs from all these spikes, like 28.79 and 28.99. And I do, as we really get into these levels, I do start looking at that because it becomes more relevant. And I want to see the VIX close below these highs. So I might look at all of them, kind of get a general idea of what the price range is, and look for the VIX to actually close below those levels. And then I want to simultaneously see, that day, I want to see the S&P close above a resistance level. That, to me, is the golden ticket right there. I mean, there's a very high probability you'll see a continuation of an up move. Or conversely, if the VIX is, down at a support level and the S&P is hitting resistance, there's a very, very high likelihood you're going to see the S&P retreat or move down. So interestingly, so as it relates to, right now and this week, watch this support level on the VIX, because I'll zoom in here and look what happened today. See, not an accident. The VIX came down, and see how it gapped down overnight because the futures moved up overnight last night. And then, so it opened lower than the close from last Friday. But see how it traded all the way down into this level or this zone? It traded down to 29.33. But then it rejected it, because see here, there was the prior resistance that is now serving as support and closed up about, 2/3 up in the range from the day, roughly. So that's what, that level is really probably why, in addition to a lot of other technical and fundamental things, that this occurred. And so that's why it's important to watch. So that's what we want to see. Now, if this level holds and the VIX starts to spike up again, and the S&P simultaneously and the NASDAQ reject those resistance zones we just looked at, then I expect another leg lower. Okay, so that's what I base my broader expectations on with the major indices. So we're at a bit of an inflection point. We have some important things to be watching this week. But I want to show you how to use moving averages for more of a medium to longer term picture of what's happening. And historically speaking, they're quite reliable. If you look at all of the occurrences of mean reversion, and then in the case of the major indices, where the price of the index is above the mean and reverts back, it finds support, dynamic support there, and then tends to move back up. And the reason that that isn't always universally applicable, the reason it's reliable with the major indices like the S&P and the NASDAQ and the Russell is that there's a long, overall long-term upward bias to the markets. Over the very long term, they go up, right? So that's where that edge comes in. And I may not look at a moving average on a single stock as significantly as I would on the indices. But still somewhat fractal in nature. It can still apply to individual stocks and also to different time frames. Okay, so that's what we're looking at on the S&P and NASDAQ and VIX for this week. Any questions, Richard, or shall we move into moving averages?
Only question I had something that came in earlier. I don't know if that student is on or not. He was wondering, he's more of an intraday trader, kind of looking at this wonderful market analysis you give. How can maybe someone in the near term take a look at this and trade intraday with some of this material, or how they kind of apply that today?
Yeah, great question. So I mean, the good news is this is very valuable for intraday trading. Even though we're looking at daily charts and doing more of we're kind of looking short term to medium and even long term, but, and as I'm going to show you in a second, we're going to actually go out long term. But even long term analysis can be very valuable for short term trading and even intraday trading. So, if you're trading intraday, and actually, whoever asked that question, if you weren't on last week, please go back and watch last week's session on the YouTube channel, on our YouTube channel, Altos Trading, because I talk about standard deviation moves from the mean. And even though we're looking at a daily chart, and I'll just show you this real quick. When you get, this is the, we're still on the VIX. Let me look at, go back to the S&P. And while I'm doing this also, even though we're performing this exercise on the major indices, but it truly should be done on any asset that you trade. And even if you're not trading, the index or an ETF that tracks it, like the SPY or the Qs, this is always my first step. So even if I'm going to trade an individual stock, I always start here with the major indices, because it's like so many things in life. You start with a high level overview, get the bigger picture, and then you get more granular and you get grind down and get into the finer details to make your decisions, right? That's, if you can train your brain to do that, it's applicable to so many things in life. And for trading, I think it's absolutely crucial. So even if you're intraday trading, this gives you the broader perspective of what's happening, so that when you're making a day trading decision and your longer term analysis, say off a daily chart, tells you there's a bullish bias, then most likely, let's say you're even doing like 10 intraday trades in a day, look back and see which, if you're doing both long and shorts, look back and see which trades did better that day, the longs or the shorts. And I believe that if you follow these exercises on longer time frames, daily charts, and really do your homework, do the analysis, and use it for intraday trading, you're going to find that ultimately, if you're trading both long and short, the positions that coincided with the broader perspective probably did better, were easier, and moving forward can hopefully help you hone in on directional moves, so that you're trading less against the market.
Yeah, I was about to say, like, you nailed it. Like, that's completely the way to go. 100% agree with you there. Like, you have to really kind of trade with the longer bias, the parent order flow, however you want to call it, because otherwise you're kind of going against the stream, and you said less probable trade if you're going kind of against the overall flow of the market. Like you said, you're seeing that it should be going down on the daily, and you should be looking at shorts that day versus trying to go long to get a counter trend. It's just more risky that way.
Yeah, swim with the current, right?
That's right. That's all I got.
Okay, cool. So yeah, that was a great question, and thanks for asking it. It's important, and I think that we have such a diverse group of members and a lot of intraday traders. I don't personally trade intraday, but everything that we talk about is crucial, even if you're an intraday trader, in terms of analysis, and a lot of it's fractal. The principle itself, if it applies to a daily chart, can be used on a lower time frame. So let's talk about that. So moving averages, and those are also fractal, right? If you put let's say you put a 50 period moving average on a daily chart, it's giving you the average price. We'll just use simple moving averages to make it easier. Exponential moving averages apply more weight to the current price. Simple moving averages simply take the average price of the daily closes, or the closes of the time frame that you're looking at. So if you put a 50-period moving average, or 50-period simple moving average on a daily chart, it's going to give you the average price over the last 50 days. If you put a 50-period moving average on an hourly chart, it's going to give you the average price over the last 50 hours, right? So the indicator is the same, but the information is different and it's fractal. So you can take one formula and apply it to different situations or different time frames, which is interesting because what a lot of retail traders often don't do or understand is that those moving average periods, it's important to apply them to the right time frame. And that's what we're going to look at. And why is that so? Well, mainly because of self-fulfilling prophecy, because the big money, large institutions watch certain moving averages on certain time frames. So we're going to look at one today that doesn't often come into play, but it just did this month for the first time in quite a while. And very few people are probably using this, but as I'll show you historically, it is very reliable and it's currently relevant. So has it failed? Yes, it's not 100%. But even when it's failed, it's served as a good zone for an indication of bullish market moves in the major indices. Okay, and so that's the 36-period moving average. I'm actually going to just move over to, in case we look at any options related topics when we get into Q&A and things, move over to the broker charting. So we got the S&P. I'm actually going to take the trade trend indicator off for a second. Okay, so the moving average that we're going to look at, and we're going to use a simple moving average, is, oh, and by the way, that's not it. So just hang on a second. We're not going to look at the daily time frame. We're going to look at, it's actually, the monthly. Okay, so let me change the period of the moving average. We're going to use a 36-period moving average on the monthly chart. So first of all, what is that? What is it telling us? On a monthly chart, when we apply a 36-period moving average, it's telling us the average price over what, the last 36 months, right? Or 3 years. Now, is that just an arbitrary random, number? No, it's not. It actually correlates with, not exactly, but with market sell-offs, bear markets, and market downturns in general. So bull markets, as we've talked about in the past, secular bull markets tend to last very long periods of time. We just came out of one, right? So we're in bear market territory on the major indices right now. And so we are in a bear market. We're in a technical bear market. But I would also say we're in a fundamental bear market. And lost my train of thought. So those tend to last a long period of time, right? We just came out of one that was what, like 12 years. 08 was our last, we had a really obviously quick, extreme sell-off and dip into bear market territory in the crash of early 2020, but popped out of it. So it wasn't really long enough to classify as a bear market. Rather, it was more of a market crash. A bear market would have been like in 08. they've got to last months, right? But they typically last like 1 to 3 years. So when we see, the higher end of that interval occur, we can use that as a barometer for bear market conditions. So yes, we could have a bear market that lasts longer, but on average, that's, we tend to have, a bear market that might last, 2 or 3 years. And then we get into these longer term bull markets because the markets have an overall longer term bullish bias. Imagine if we only had these brief period up moves in the market followed by 10 or 12 year moves down in the market, right? The stock market wouldn't be what it is, right? So overall, and not only that, it's we'd have serious economical problems because that would mean companies aren't, experiencing earnings growth and positive earnings and things. So the economy tends to grow over time with these briefer periods of trouble or bear markets, as we call them, as it relates to the stock market. So that's the rationale for using a 36 period moving average on a monthly chart. So let's look at that and kind of see longer term what that tells us, what's happened historically, and what's happening right now. Okay, so as you may have already noticed as I was talking, this month we've come down into the 36-month moving average. All right. So let's look at what's happened in the past around that average. Well, as I mentioned, it's not 100%. Price isn't going to necessarily come right to that level and then stop, right? It can go below. And that happened in 2020, right? We did dip way below the 36 period moving average on the monthly. But then in April, closed back above. And that's, by the way, what I wait for confirmation. And we'll talk about that here in a second. Aggressively, you could, trade right off that level. People obviously did, because see what happened. Price dipped below and then is now trading above. So this is aggressive price action behavior from bigger money, driving prices back up in June above this level. But that's aggressive because we don't know what's going to happen between now and the end of June. We could come back down below. And that's where I start to get more granular with lower timeframes like the daily chart. But anyway, so COVID crash right here, right? But see how price ultimately used this zone as support, and we got a big move off. And by the way, as I'm showing you these, pay attention to the move that happens from the level, right? Parabolic move. Let's look at the last one. This one was more precise, right? So this is going into 2019. We had a pretty choppy market in 2018, a lot of volatility. You can see that on the monthly chart. See how easy to see on a monthly chart when you see these big wide ranges on a monthly closing basis. Look at these wide range with a lot of volatility. And volatility tends to peak, be higher in the early part of the year, die down in the middle part in the summer, and then pick up again in the later part of the year, latter part of the year. See that? So see how these ranges in the center were much tighter and they were much wider on the ends. But what happened off this mean reversion at the 36-month moving average? Big move up off roughly the 2400 level or 2500 level, up into about the 3400 level. Huge move. Okay, let's look at the next one. So there it was right there, right? So right in the beginning of 2016, January, February, we see this rejection, right? Price dipped below, and then here was the confirmation. The confirmation didn't come until March. There was the bullish close above. But look at that move. Another parabolic move from around the 2000 level up into about the 2800 level. Okay, let's look at the next one. All right, so this was going back into 2011. So you can see these don't happen often, but that's why we're focusing on that this week, because it's happening this month. So we need to pay attention to it. Okay, but there was the dip below. Price closed above. Look at that steady, but see how price moves so smoothly when that level, when that 36 period monthly moving average holds. See how steady that move up is? So has it failed? Yes. When was the last time it really failed? I wouldn't count early 2020 because that was a market crash. It failed in 08 in the housing crisis. So there was the test of the average, but we dipped below it, right? And that's why we don't just use moving averages to make our trading decisions. We use horizontal support levels as well, which there was one from years earlier before this rebounded. But how would I navigate this? Well, at these more recent examples we just looked at, we saw the dip below and then the close above. So see how this failed? We got the dip below and the close above, but then something happened here, like midway through the year. We got after the close above, because that happened here, looks like May, June, April, May, or May, June. We had two consecutive closes above the average, looking like it was going to hold. The housing bubble bursts, and we get a close back below. That's a bad sign. So if you get dips or closes below the 36 monthly moving average, and then closes above for a month or two, and then it closes back below, very bad sign. So watch that as it relates to current times. But that's what happened here. So if we had used that as a barometer, assuming we were using nothing else and just looking at the 36-month moving average, we would have gotten, this would have been our first losing situation, right? If we were using the conservative approach of closes or trading below the level and then close above, this would have been our but that's why you need to look for a failure or a false indication of a bullish move off the 36-month moving average, because then we got a very bearish close below, and in the second half of the year the market lost over half of its value, right? So it was just parabolic down move right into this support level, that horizontal support level.
I bet most people have never even seen this or thought of this at all. Like, this is pretty incredible to see this.
Yeah. And I didn't come up with this, guys. This is actually, I've actually talked to some of my trading colleagues about this. It's very closely watched among hedge funds, institutions. You may see people talk about it on, financial networks and things, but probably not a lot. So that was our warning back in 08, 09. So you would have had to be really patient here, because if you really were waiting for a strong bullish close above that 36 period monthly moving average, didn't happen until the next year, right? So you got a bullish move here. You could have traded off horizontal support or used the mean reversion technique. This is where I'd throw in the Bollinger Bands and look for a 2 standard deviation move. I would adapt the moving average to the 36 period and use a 2 standard deviation volatility band. And I'm not going to take the time right now to throw that up, but there's a good chance that this, trailed the 2 standard deviation move and then mean reverted. It definitely mean reverted to the 36 period average, but also off a horizontal support level. So an aggressive approach would be to, trade from this horizontal support level, but the conservative is to trade on the breakout. Now, anytime we trade for a significant period of time, I would say, 6 months or longer below the 36-month moving average, and then we finally break through it like we did here, we're very likely to have a retest. So it's not like when it holds and then price moves off it, where you get these nice parabolic uptrends. We tend to get a retest. So that happened here, but those can be great entry opportunities. Obviously, we looked at that just a minute ago. And then, of course, we had the longer. Remember, I mentioned the rationale for using a 36-month moving average. We had a bear market in the late 90s, early 2000s, right? Because of the dot-com bubble. So that was back here off the chart. And that also happened there, right? But as price finally recovered back above 36-month moving average, sorry, it's a little small here, but look what happened. There was our confirmation. We got some sideways movement and not a full retest of the 36, but price never even dip back below or close below it. And we get a really nice rebound there. It doesn't look as nice on the chart because of the scaling, right? Because we have if I were to take all this off and move over, this is a big move up. Very big move up. So I encourage you to run this exercise at home, go back and look at these, use the 36-month moving average and go back, much further. We're looking back 20 years. This is a 20-year look back, but see how reliable it is over a period of 20 years. And, even forget the reliability. It's the relevancy of it, right? And the reason it's the focus of our topic this week, because that's where we are right now. Right? So this is another tool to add to the analysis that we do on our weekly sessions. And it's not always going to, we don't have a lot of opportunities for this to happen. But when it does, it gives us a lot of good information and it creates potentially some really amazing trading and investing opportunities. So am I jumping in and buying right now? No, not necessarily. But I'm watching 3,700 on the S&P because that's where that hugely significant 36-month moving average period is, right? Level or zone, 3,700. By the way, I'd already marked that on the chart. Look at that. Before this, I marked that back at the beginning of May. So almost 2 months ago. Okay, so we really need to watch what happens at the close of June. Is price going to close above? And then as we get into the summer months, remember volatility tends to settle down. It may not settle down quite as much this year because of, in the context of inflation and the war and all these geopolitical things that are taking place. And what's unique this year too is inflation it's not just in the US. This is a worldwide issue. The US is getting hit particularly hard, but rising interest rates and things. So I think we'll see lower volatility starting July through the summer months, but it may not settle down as much as it has in past years. But you can see we've obviously had huge volatility. Look at the ranges, the high and low ranges of the months in 2022 compared to past months, right? They're big. They're rivaling the ranges, that we saw back in the COVID crash. I don't think we've seen one as big as the March one, but you can see that we're seeing very wide ranges and therefore high volatility every single month so far this year. So it may settle down, but not as much as past years. So what we want to watch for July and August and through the rest of this year, but probably near term, right? So this month, next month, and depending on what happens this month and next month are critical. And, that August, September, October could become critical just depending on where we see the close relative to the 36-month moving average on the monthly chart. Critical for telling us, is the market, is the bearish market going to stall and potentially reverse back into a bull market? Now, fundamentally, I think it's pretty early considering what's going on fundamentally. We're really only 6 months into this bear market, right? And as we saw, like in the dot-com bubble, bear markets can last several years. But in 08 was bad. That was really, really bad. And the bear market really only lasted the second half of 08 and then part of 09. And then we got the rebound. So again, they tend to be much shorter lived than a secular bull market. And we're entering some very interesting territory right now. So so watch this. And you can look at this on other indices, the Russell, the NASDAQ, and use it as a barometer for all the major indices. I don't use the 36-month so much on like an individual stock. For those, we use other moving averages, and those tend to be the 50 period and 200 period moving averages. And we can talk more about those on future sessions. But I don't want to take away from the importance of this. And so I think it's good to focus on this 36 period moving average on the monthly chart to give us a barometer of what may happen through the rest of 2022 and into subsequent years. Because it can, number one, help us navigate whether the bear market is kind of finding its base. And even though it could stay, low, like we looked at, over a decade ago, where, price kind of moved sideways for a year, that can happen. And price can hover around this mean for, a year. I don't think it will, because of the magnitude of what's going on and the volatility levels. But I think we're going to either see a strong hold of this level or a fake out and a break back below it. And then we can talk, if that happens, we'll obviously talk and focus more on that, in future sessions. But, if that happens, I'm actually would be very, happy for the opportunity it would provide, because, if we get back down and again, I'm not going to get real into this right now, but if we get back down in like the 3,000 to 3,500 zone, oh my gosh, I would probably, jokingly, like I did, like when I was back in school, like I just wanted to take all my student loan money and put it into the stock market. Thankfully, I didn't do that, but it's like I would, mortgage my house, get a second mortgage, and just put everything I have if the S&P gets down to 3,000. But definitely in this 3,000 to 3,500 zone, I'm all in to the long side as a bull. So we're not anywhere near that. We may never get there, and we may see a near-term rebound, kind of like shorter to medium-term rebound, and then a fake out and a close back below. But for those of you who use bearish strategies, or if you're an options trader and you use bearish option strategies, or you short stock or whatever, this can also create good opportunities for you if we get a close. So we want to see, like we did in that past example I looked at, we want to see a close above at least 1 or 2 months, and then so that's the fake, and then a close back below. And just like we saw previously in the latter part of 08, that often results into another big leg lower. Okay, so again, we'll get to that, if we come to it. But and if that does happen, that this is the zone I'm looking at, but we'll talk more if that happens. We don't know yet. But for now, this is what we're watching. All right, so I went a little bit over the hour. I want to answer any questions that have come through, and I think what we'll do is we'll continue to watch this, of course, on subsequent sessions in the coming weeks and months. But I think for next week we'll just we'll do our initial market analysis and then devote the whole rest of the session to ticker roundtable, so you guys can share things that you want to look at, since we ran a bit over and want to be fair to everybody. I don't want to take one or two and then have a lot of people not able to look. So we'll devote next week to ticker roundtable, and then we'll continue to follow this up. So let's go ahead and just take any remaining questions that you guys have for the evening.
Let's see. Raju wanted to know why the 36 monthly, not the 50.
Yeah. So Raju, maybe you missed earlier on. So the rationale for the 36 month or 36 period on the monthly chart is that's 3 years, right? If you were to use a 50 period moving average on a monthly chart, that's 50 months. You can manipulate the moving average period and change time frames, but I want to look at the time frame that coincides with the moving average period. So if I want to look at a 3-year period and get a bigger perspective of what's going on in the market, I'll use a monthly chart. So then I would have to use a 36 period moving average. And the other part of that, as I mentioned, was the rationale for using it as a mean reversion tool when we're entering bear markets, right? So we're in a bear market right now, and we've mean reverted. And the rationale for that 36 period moving average is it tends to encompass, in terms of time frame, the typical range of a bear market. So when we look at the .com bubble, we were in that one for a few years. 08 shorter, but usually we dip into a bear market and we're back out within a few years, over the past several decades. So that's the rationale for using that. 50 period moving average and 200 period moving average, I used those off of daily time frames, right? So we're getting a 50-day and a 200-day average price. And we'll look at those more in future sessions as well.
Ed just asked to clarify, those are monthly calendars, not 30-day period.
Correct. Yeah. So the chart we were just looking at with the 36 period simple moving average was a monthly chart. So every candle you saw was encompassed the high, low, open, and close of the month, right? So each one of these candles is a month. So this is June, this is May, April, March, so on and so forth.
All right. Also 36 MA and not EMA.
Yeah, so Ed, we used a simple moving average, not the exponential. What the exponential does is it provides more weight to the current price action. So when that might be more useful for like day trading or shorter time frames. But when we're looking at a bigger picture perspective, I just use the simple moving average.
And do you ever look at the NASDAQ comparison with the S&P on that, or is it really more?
Yeah. As I mentioned, like what I just demonstrated on the S&P can be used with all the major indices, the NASDAQ, the Russell. But in consideration of time, we just didn't have it to go through all of the major indices. But definitely relevant and should be analyzed on all the indices, including the NASDAQ.
All right, that's all I got for now.
All right. Well, thanks, guys. I hope you got a lot out of that, and I hope it helps you navigate the markets here, not just in the very short term before we meet next Tuesday, but in the medium to longer term as well. Yeah, thank you, Raju. Thanks to all of you. Thanks, Ed. And we'll continue to follow up with this, right? We're going to keep watching this because it's happening now, right? And we want to see how it's going to impact the markets moving forward. And and that's hugely important for shorter term strategies. So whether you're day trading or swing trading or long-term investing, this is an important time to be watching these things. So I hope you guys join us next week. We'll see you same time, same place, Tuesday, 7 p.m. Eastern time. In the meantime, if you have any questions, let us know, support@altostrading.com. Hope you guys have a great rest of your trading week, and we'll see you next Tuesday.